8 a.m., January 8th. You're staring at the Bloomberg terminal. The screen is bleeding out. Silver takes a nosedive. Gold follows. In seconds, billions in market cap just evaporate. You frantically check the news wire. Did a bank collapse? Did the Fed announce a surprise hike? Did a war just start? No, nothing. Silence. The economy is fine. The mines are still operating. The demand for industrial chips is skyrocketing. Yet, your portfolio is being slaughtered right in front of your eyes. Why? Because a few lines of code in a server room somewhere in New Jersey just executed a single command. Sell. This isn't panic. It's protocol. It's the annual index rebalancing. A mechanical purge forcing passive funds to vomit out $6 billion in silver and $5 billion in gold over a 5-day window. They are selling regardless of price, regardless of value, regardless of you. But here's the part the news anchors won't tell you. In a market, for every reckless seller, there must be a willing buyer. If the algorithms are dumping 10% of the entire silver derivative market in less than a week, ask yourself, who is standing on the other side, holding the bucket? You think you're watching a market correction? Look closer. You're witnessing a heist. Mute the TV. Seriously, mute it. If you are listening to the mainstream financial news right now, you are being fed a sedative. They are using polite, sanitized words to describe what is happening to your money. They call it technical correction. They call it profit-taking. They call it market noise. These are phrases designed to keep your heart rate down while your net worth is being quietly extracted. What you are watching on the charts, those red candles bleeding down the screen, is not noise. It is a mechanical liquidation event. It is a mathematical certainty that was scheduled months ago. And yet, somehow, nobody told you it was coming. Let's strip away the euphemisms and look at the raw data of the crime scene. We are currently in the middle of the rebalancing window. It began on January 8th, and it will grind on relentlessly until January 15th. The perpetrators are two invisible giants, the Bloomberg Commodity Index, or BCOM, and the S&P GSCI. These aren't people. They are indices. They are the massive, passive whales that dictate where hundreds of billions of dollars in pension funds and ETFs must flow. And right now, their algorithm has a single, non-negotiable directive: purge. Here's the logic, if you can call it that. In 2024 and 2025, gold and silver performed too well. They rallied. They got expensive. They grew too fat for the index's predetermined diet. To get back to their target weightings, the rules of the index mandate that they must sell the winners. They are not selling because the outlook is bad. They are selling because a spreadsheet said, "You have too much profit. Get rid of it." Let's talk numbers, because the scale of this sell-off is frankly terrifying. We are looking at an estimated net sell order of $6.1 billion in silver and another $5.6 billion in gold. That is nearly $12 billion of selling pressure compressed into a 5-day window. To the uninitiated, $6 billion might just sound like another big number in a world of trillion-dollar deficits. But in the silver market, that is a nuclear bomb. The silver market is tiny. It is illiquid. It is volatile. Throwing $6 billion of sell orders into this market in 1 week is roughly equivalent to dumping 10% of the entire open interest on the COMEX. Imagine a crowded theater. Now imagine 10% of the audience decides to sprint for the exit at the exact same second. Not because there is a fire, but because a bell rang. That is the crush you are seeing on the charts. It is a liquidity vacuum created by a mindless algorithm. Most retail investors see this red ink and they panic. They think the sky is falling. They sell at the bottom because they trust the price action more than the fundamentals. And this brings me to a checkpoint. If you are the type of person who prefers comforting lies, or to the moon hype, This investigation is going to make you very uncomfortable. You should probably stop watching. But if you are part of the minority that wants to see the gears grinding behind the ticker tape, if you want to understand how the machine is rigged so you can stop being its fuel, then you are in the right place. Acknowledging that by subscribing is the only way to ensure you don't miss the rest of this file. We are building a dossier here that the algorithms don't want you to read. Now back to the paradox. I call this the blind paradox because the BCOM algorithm is effectively blind. It cannot see the real world. While this machine is dumping $6 billion of silver contracts onto the floor of the exchange, look at what is happening outside the window. The industrial demand for silver is at an all-time high. The photovoltaic sector, solar panels, is consuming silver faster than miners can dig it out of the ground. The AI revolution isn't just about code, it's about chips, and high-end electronics require silver contacts. We are in a structural supply deficit. The physical inventories in London and Shanghai are being drained. By every logical economic metric, supply versus demand, the price should be skyrocketing. But it's crashing. Why? Because the paper market and the physical market are two different dimensions. The BCOM algorithm operates in the paper world. It doesn't sell physical bars of silver. It sells futures contracts. It sells promises. And when you sell $6 billion of promises in a week, the price of the promise collapses, dragging the spot price down with it. This creates a distortion in reality, a glitch in the matrix. You have an asset that is becoming scarcer and more valuable in the real world, while becoming cheaper and cheaper on your screen. This is not efficient market theory. This is a malfunction. And this leads us to the million-dollar question. The question that turns this from a market analysis into a crime thriller. In a trade, there are always two sides. For every seller, there must be a buyer. If we know that the seller is a blind robot, forced to dump $11 billion of assets, regardless of price, who is on the other side of that trade? Who has the liquidity, the sophistication, and the sheer audacity to stand under this waterfall of selling and hold out a bucket? Think about it. If you knew your neighbor was forced by a court order to sell his Ferrari for pennies on the dollar by Friday afternoon, would you be scared of the low price? Or would you be the first one in his driveway with a checkbook? The smart money isn't panicking. They aren't selling. They are harvesting. But who are they? And more importantly, once they absorb this massive transfer of wealth, what do they plan to do with it? Because the data suggests they aren't just buying paper contracts to flip for a quick buck. They are doing something much more permanent. We are about to trace the money, and where it leads will explain why your portfolio is bleeding and why the bleeding is part of the plan. To understand why your portfolio is currently hemorrhaging value, you have to stop looking at the financial markets as a casino where luck decides the winner. You need to start viewing them as a factory. A casino implies chance, a roll of the dice, a spin of the wheel where the outcome is uncertain. A factory, however, implies a process. It implies a conveyor belt, a set of rigid instructions, and a predictable output. What we are witnessing right now in the precious metals market is not a streak of bad luck. It is a feature of the system. It is a scheduled maintenance cycle designed to strip excess value from one group of investors and transfer it to another with industrial efficiency. We call this the mechanical harvest. Most legitimate investors operate under the delusion that the price of silver is determined by millions of rational humans making decisions based on news, supply shortages, or economic data. That is a comforting fairy tale. In the modern financial ecosystem, the marginal price, the price blinking red on your screen right now, is determined almost exclusively by the massive, mindless flows of passive capital. Passive capital is dumb. It does not think. It does not read the news. It follows a strict set of rules written into a prospectus decades ago. To see exactly where the failure point lies, we have to dismantle this machine piece by piece. The engine of this sell-off is the rebalancing protocol of the two largest commodity indices in the world, the Bloomberg Commodity Index and the S&P GSCI. These indices operate on a philosophy of forced diversification. To ensure that no single asset dominates the basket, they enforce strict weighting caps. Think of it like a strict dietary restriction for a professional athlete. The algorithm is programmed to believe that gold should only make up roughly 15% of the portfolio, and silver perhaps 4 or 5%. Here is the bitter irony of the situation. The trigger for this crash was not failure. It was success. Throughout late 2024 and 2025, gold and silver rallied aggressively. They performed exceptionally well, acting exactly as the safe haven assets they are supposed to be. As their prices rose, their total value within the index ballooned. They became overweight. The gold slice of the pie grew to 18 or 19%. The silver slice expanded well beyond its target. To a human investor, this is great news. You let your winners run. But to the BCOM algorithm, this is a critical error, a violation of protocol. So, when the January rebalancing window opens, specifically from the 8th to the 15th, the machine executes a mandatory liquidation command. It must sell the winning assets to buy the losing assets, like natural gas or soybeans, to return the portfolio to its perfect, pre-programmed pie chart. It is punishing the asset for being successful. This is a structural inefficiency that borders on insanity. It means that nearly $12 billion of selling pressure is hitting the market specifically because the fundamental case for precious metals was correct. The price is being forced down by the very mechanism designed to track it. If this were just a matter of selling, the market might be able to absorb it over time. But it is the specific mechanics of how they sell that creates the catastrophe. The funds tracking these indices, the ETFs and the pension funds, are price agnostic. They do not care if silver is trading at $30 or $20. Their only mandate is to match the index weighting by the close of the trading day. They execute what are known as market-on-close orders. This is the financial equivalent of throwing a hand grenade into a crowded room and then locking the door. A market-on-close order effectively tells the broker to sell 5,000 contracts at 4 p.m., regardless of the price. Just fill the order. When you have billions of dollars of these blind sell orders hitting a niche market like silver, which has a fraction of the liquidity of the S&P 500, you create a liquidity vacuum. The buyers on the other side see this wall of selling coming. They are not stupid. They pull their bids. They step away from the market. As the bid depth vanishes, the algorithm keeps selling into thin air. The price gaps down violently. It triggers stop losses from retail traders who are watching technical support levels. Those stop losses trigger even more selling. It is a reverse domino effect, where the mechanical harvest doesn't just cut the crop, it scorches the earth. This leads us to the darkest part of this anatomy, the part where the machine isn't just blind, but is being actively weaponized by human predators. Wall Street is a zero-sum game. For every dollar lost by a passive index fund, a dollar is gained by an active predatory desk. The rebalancing schedule is not a secret. It is published public information. Everyone with a Bloomberg terminal knows that on January 8th, the BCOM funds must sell. Enter the high-frequency traders and the bullion banks. These entities engage in a tactic known as front-running. Days before the rebalancing window actually opens, these predators aggressively short the market. They flood the exchange with paper sell orders to drive the price down before the index funds even wake up. Their goal is to induce panic. They want to paint the charts red. They want to break the psychological spirit of the retail holder. They want the price to be as low as possible when the big rebalancing volume finally hits. Then, on January 8th, the index funds step in and start their mandatory dumping. The price collapses to a local bottom, driven by the sheer weight of the passive selling. And that is when the trap snaps shut. The predators use the massive volume provided by the desperate index funds to buy back their shorts and flip to a long position. They are literally using your retirement fund's forced selling to exit their short positions and enter long positions at rock-bottom prices. They sold high to you last month, and they are buying low from you right now. The volatility isn't random. It is engineered. The machine was calibrated to shake you out. And if you sold during this window, it worked perfectly. Let's zoom out and look at the blueprint of what just happened. What you are experiencing is not a market crash in the traditional sense. It is a wealth transfer. It is a transfer of assets from passive hands, meaning the public, the pension holders, and the ETF buyers, to active hands, meaning the trading desks, the insiders, and the whales. The passive investor pays management fees to a fund manager to have their wealth automatically harvested once a year. The system is designed to penalize the inactive participant. By relying on the safety of the index, you have exposed yourself to the ruthlessness of the mechanism. This system is broken. It is functionally obsolete, but it persists because it is profitable, not for you, but for the people operating the harvest. We have now dissected the machine. We know how the price is being manipulated down. We know the selling is artificial, mechanical, and predatory. It creates a distorted reality, where the price on the screen has divorced itself from the value of the asset. But every crime leaves a fingerprint. While the paper market on the COMEX is screaming that silver is worthless and dumping contracts by the truckload, there is another market, a quieter, physical market that operates in the shadows of the exchange, that is telling a completely different story. We need to look at the data that the algorithms ignore. We need to look at the warehouse inventory levels, because while the price on your screen is dropping, the physical metal is disappearing from the vaults at a rate that is mathematically impossible to sustain if everyone is supposedly selling. The system is rigged, yes, but the rig creates a paradox that is about to snap, because you can print paper contracts to drive the price down, but you cannot print silver bars to satisfy the delivery demands of the people who are secretly buying the dip. We are now standing inside the engine room of the COMEX, and the gauges are redlining. To understand the sheer violence of what is happening right now, we have to stop looking at the price and start looking at the pressure. The metric that matters most in this investigation is open interest. Open interest is the total number of active contracts or the bets that have not been settled. It is the measure of how much tension is in the system. When we say the index rebalancing is dumping $6 billion of silver, that is an abstract number until you compare it to the size of the container it is being poured into. That $6 billion represents roughly 10% of the entire open interest of the silver market. Imagine you are living in a neighborhood with 100 houses, and suddenly, without warning, 10% of your neighbors throw their homes onto the market on the exact same Tuesday morning. They do not care about the price, and they demand cash by Friday. That is not a market adjustment. That is a liquidation event. That is a structural stress test designed to break the floorboards of the exchange. When we examine the Commitment of Traders report, which is effectively the maintenance log of who is holding which lever, we see a massive divergence that proves our theory of the mechanical harvest. The non-commercials category, which represents the managed money. The hedge funds and the blind algorithms we discussed earlier are puking long positions. Their line on the chart is plummeting vertically. They are the crop being cut down. But look at the commercials. These are the bullion banks, the swap dealers, the mechanics who actually operate the machine. Their position is doing the exact opposite. As the price crashes, they are not fleeing. They are covering their shorts. They are absorbing the selling pressure with frightening efficiency. The algorithms are selling because they have to, but the banks are buying because they want to. This 10% churn in open interest is not money leaving the ecosystem. It is money changing caste. It is the transfer of ownership from weak programmatic hands to strong informed hands. The machine is shaking the tree, and the smart money is standing underneath, with a basket catching every single falling apple. But here is where the machinery starts to grind against reality. In a functioning free market, the price on the screen should reflect the price in the street. If silver is crashing to $20-something on the COMEX, you should be able to walk into a dealership and buy it for that price. But try it. Try buying a Silver Eagle or a generic bar for the spot price you see on Bloomberg. You cannot do it. This brings us to the phenomenon of volume divergence and the explosion of premiums. The paper market, which is the futures contracts traded by the algorithms, is signaling a crash. But the physical market, which is the actual metal you can hold in your hand, is signaling a shortage. The premium is the extra fee you pay over the spot price to get physical delivery. It is the ghost in the machine. It is the market's way of screaming that the spot price is fake. When the index funds dump billions in paper contracts, the spot price drops, but the premium rises to compensate. It is like a hydraulic press pushing down on a balloon. You can flatten the shape, but the volume just displaces to the side. The divergence between the paper price and the physical price is now so wide that it suggests the exchange itself is becoming broken. We are seeing a bifurcation of reality. On one side, a digital simulation, where silver is cheap and abundant. On the other side, a physical logistical network, where inventory is tight and premiums are hardening. The mechanical harvest can manipulate the digital ticker, but it cannot manufacture physical atoms. This brings me to a reality check, and I need you to be my eyes and ears on the ground for this one, because I am looking at charts in a terminal, but you are out there in the real economy, where the metal actually changes hands. I want you to go to your local bullion dealer, or check the online retailers you use and tell me what you see. Are they panic selling? Are they dropping their premiums to match the drop in spot price? Or are they holding the line and charging you $30 for an ounce that the screen says is worth $26? I want you to comment below with your location and what you are seeing. Tell me spot is down, but my dealer is charging X. Let us build a map of the real price of silver. Right here in the comments, because I suspect the data we are being fed by the exchange is lagging miles behind the reality on the street. Now let us look at the final piece of technical evidence, which is the term structure. In a legitimate bear market where nobody wants the asset, the future price should be lower than the current price, or at least the curve should be flat and lifeless. But look at the forward curve for silver. It is in contango, which is normal. But watch how the spread between the months is behaving. It is not collapsing. Despite the massive selling, the structure of the market remains spring-loaded. The term structure is storing energy. When you compress a spring, it looks smaller. It takes up less space. A novice looks at a compressed spring and says, "Look how small and weak it is." An engineer looks at a compressed spring and steps back because he knows it is full of potential kinetic energy waiting for the thumb to be removed. The index rebalancing is the thumb. It is pressing down on the price with billions of dollars of artificial weight. But the internal mechanics of the curve, the lease rates, the forward spreads, show that the spring is intact. It has not snapped. It is merely coiled. The moment the calendar flips to January 16th, the moment that mandatory selling pressure is lifted, the thumb is removed. And what happens to a spring that has been compressed by 10% of its total mass when the weight vanishes. It does not just return to neutral. It snaps back violently in the opposite direction. The technicals are not painting a picture of a dying asset. They are painting a picture of a coiling mechanism. The only reason the price is down is because a non-economic actor is forcing it down. Once that actor leaves the stage, physics takes over. However, there is one variable that technical analysis cannot account for. We have analyzed the machine in New York. We have looked at the gears of the COMEX and the algorithms of the West. But this conveyor belt does not end on Wall Street. The silver that is being shaken loose by this harvest is not just sitting in a vault in Manhattan, waiting for the price to go back up. It is being loaded onto pallets. It is being put on ships. And those ships are setting a course for a destination that does not care about the Bloomberg Commodity Index. The West is selling paper, but the East is buying atoms. And to understand the true endgame of this harvest, we have to leave the trading floor and look at the geopolitical map, because the buyer of last resort has a flag that is becoming dangerously familiar, and they are playing a game that makes the COMEX look like a warm-up act. We have spent the last 20 minutes staring at charts that represent the digital hallucination of wealth, but now we must look at the physical map where the actual transfer of power is taking place. If you track the shipping manifests and the vault withdrawal logs from the London Bullion Market Association, a disturbing pattern emerges that turns this financial story into a geopolitical thriller. While the mechanical harvest in New York is busy crushing the paper price of silver down to bargain basement levels, there is a massive bucket waiting on the other side of the world to catch every ounce that falls. That bucket is the Shanghai Gold Exchange. Right now, as the BCOM algorithm forces American and European funds to vomit out billions of dollars in precious metals, a significant arbitrage window has opened up. In Shanghai, silver and gold are trading significantly higher than they are in New York or London. This is not a rounding error. It is a persistent premium that acts like a giant vacuum cleaner. It creates a gravitational pull that sucks physical bars out of Western vaults and sends them moving east. This is the global version of the mechanical harvest. The West runs a computer program that says, sell everything, because the price went up too much. The East looks at the spot price dropping below the cost of production and says, thank you very much. We will take it all. They are using our own financial sophistication against us. They are letting our blind adherence to passive indexing subsidize their accumulation of strategic reserves. This brings us to a terrifying oversight in American national security. We tend to think of silver as a monetary metal or a jewelry metal, but to a military planner, silver is a strategic material. It is the second most used commodity in aerospace and defense technologies. You cannot build a Tomahawk missile without silver. You cannot build a fighter jet control system without silver. You cannot build the advanced microchips that run the entire AI infrastructure of Silicon Valley without silver. It is the most conductive metal on the periodic table, and there is no substitute for it in high-performance electronics. By allowing financial algorithms to dictate the price of this critical resource, we are effectively running a clearance sale on the building blocks of modern warfare. China understands this. They are not buying silver because they like shiny rocks. They are buying it because they know that in the event of a kinetic conflict or a trade embargo, the nation with the physical stockpile wins. While the Federal Reserve plays games with interest rates to manage the paper economy, the People's Bank of China and their state-affiliated entities are playing a game of resource domination. They are draining the COMEX and the LBMA dry. Every time the BCOM rebalances and dumps $6 billion of paper silver, it triggers a drop in price that allows Beijing to top up their strategic reserves at a discount. We are essentially selling the bullets to our future adversaries because a spreadsheet in New Jersey told us our portfolio was overweight. It is a level of strategic incompetence that borders on treason, but it is completely legal because it is just business. This is not an accident. It is a loophole in the Western capitalist structure that has been identified and exploited. The mechanical harvest is supposed to recycle capital within our system, but instead, it is leaking real wealth out of the system. The West gets the dollars, which can be printed into infinity. The East gets the metal, which is finite and essential. Over time, this transfer creates a disparity that no amount of GDP growth can mask. You can print money to bail out a bank, but you cannot print silver to build a solar panel or a guidance system. When the physical inventories in the West finally hit zero, and the data suggests we are dangerously close to that floor, the price discovery mechanism will shift from New York to Shanghai. We will wake up one morning and realize that the price of silver is no longer set by the BCOM algorithm, but by the Communist Party of China. And this fits perfectly into the broader mosaic of the BRICS alliance. Brazil, Russia, India, China, and South Africa are openly building an alternative financial architecture that bypasses the US dollar. They have stated clearly that they view the weaponization of the dollar system as a threat. Their solution is a return to hard assets. They are accumulating gold and silver, not just for industry, but as the backing for a new settlement mechanism. They look at the US debt spiral and the rampant printing of fiat currency, and they see a burning building. They are using the suppression of precious metals, prices, driven by these very index rebalances, to trade their paper trade surpluses for hard money. Every time a Western pension fund sells gold because of an index rule, a central bank in the East buys it to diversify away from the dollar. This is the ultimate irony of the mechanical harvest. We think we are managing risk by rebalancing our portfolios. We think we are being prudent by taking profits. But in reality, we are being stripped of the only assets that will matter when the fiat currency experiment finally implodes. The flows are undeniable. The gold is moving from west to east. The silver is moving from west to east. And the only thing moving from east to west is cheap consumer goods and more debt. The geopolitical web is tightening, and the rebalancing event of January 8th was not just a market fluctuation. It was a massive shipment of wealth, leaving our shores likely never to return. So what does this mean for you? Sitting at home, watching your 401k balance fluctuate. It means that the financial products you have been sold are designed for a world that no longer exists. They are designed for a world where the US dollar is the undisputed king, and resources are infinite and cheap. That world is gone. We are entering an era of resource nationalism and currency warfare. If your wealth is tied up in paper indices that blindly sell the most valuable assets on Earth to our geopolitical rivals, then you are not an investor. You are collateral damage in a war you did not even know was being fought. The window to sit at the table with the smart money is closing. The physical inventory is drying up. And when the music stops, the only people who will have a chair are the ones holding the metal, not the paper receipt. The verdict is coming, and it will not be delivered by a judge, but by the harsh reality of supply and demand. Ladies and gentlemen, the jury is in. We have spent the last 30 minutes combing through the wreckage of what the financial media calls a market correction, but what we have identified as a structural crime. We have analyzed the fingerprints left on the tape. We have traced the digital footprints of the BCOM and GSCI algorithms. We have followed the physical shipping manifests from the vaults of London to the ports of Shanghai. The verdict is undeniable. What you have witnessed this week is not a reflection of the true value of silver or gold. It is a mechanical harvest. It is a system designed to punish the winners, to subsidize the losers. It is a mechanism that allows the passive savings of the American middle class to be strip-mined by the active predators of Wall Street and the strategic planners of the East. The index rebalancing was merely the cover story. It was the smoke grenade thrown into the room to mask the heist. While you were panic selling because the line on your screen went down, the smart money was panic buying because they know the inventory in the vault is running out. We have proven that the price drop was artificial, driven by a mandatory liquidation rule, not by economic reality. We have proven that the buyers on the other side were covering shorts and taking physical delivery. And we have proven that this entire charade is draining the West of its strategic resources, leaving us holding paper receipts, while our competitors hold the periodic table. So where does this leave us? We are standing at a fork in the road, and there are 3 distinct timelines that could play out once the clock strikes midnight on January 15th and the rebalancing window officially closes. You need to be prepared for all of them, because hope is not a strategy. And in this market, ignorance is expensive. The first scenario is what we call the paper tiger. This is the bear case. In this version of the future, the mechanical harvest continues to work exactly as designed. The Federal Reserve keeps interest rates higher for longer, which keeps the pressure on the paper market. The algorithms continue to dominate the price discovery mechanism. The disconnect between paper price and physical reality widens, but it does not break. The bullion banks manage to shuffle enough inventory around to keep the illusion of liquidity alive. In this scenario, the price of silver might languish in this suppressed range for months, frustrating the holders and shaking out the last of the weak hands. The wealth transfer continues slowly and silently. The East keeps draining the vaults, but they do it quietly without spiking the price. If you are a short-term trader, this is a nightmare. It is a slow bleed. But if you are a long-term accumulator, this is actually a gift. It is an extended window to trade your depreciating fiat currency for real assets at a subsidized price. The second scenario is the V-shaped snapback. This is the bull case, and statistically, it is the most probable outcome based on historical data from previous rebalancing events. Think of the silver market right now as a beach ball being held underwater. The BCOM selling pressure is the hand pushing it down. It requires massive, constant energy to keep that ball submerged. On January 16th, that hand gets tired. The mandatory selling stops. The $6 billion of sell orders vanish from the order book. But the buoyancy, the fundamental demand from solar, AI, and military manufacturing is still there pushing up. What happens when you remove the hand from the beach ball? It does not just float up gently. It rockets out of the water. In this scenario, we could see a violent repricing to the upside in the second half of January. The shorts who were late to cover will get squeezed. The retail investors who sold at the bottom will chase the price back up. The chart will look like a V, and the media will scramble to find a narrative to explain why silver is suddenly soaring. But you will know the truth. It is simply physics taking over after the manipulation ends. But there is a third scenario, a darker scenario, the wild card. We call this the delivery failure. This is the black swan event that keeps bullion bankers awake at night. In this scenario, the mechanical harvest works too well. It drains the physical inventory too fast. One day, maybe next week, maybe next month, a major entity stands for delivery on the COMEX. They bought the contract, and now they want the metal. But the vault is empty. The bars are gone. They are in Shanghai. They are in Mumbai. They are in private vaults. The exchange declares a force majeure. They try to settle in cash. They say, here is your $25 per ounce in cash. Take it and go away. but the buyer refuses. They need the metal for their factory or their strategic reserve. Panic ensues. The paper market instantly becomes irrelevant. The real price of silver decouples completely from the spot price. In this world, the price isn't on a chart. The price is whatever you have to pay to get someone to actually part with their metal. This is the musical chairs moment, where the music stops and the world realizes there are 100 people and only 3 chairs. This is not just a bull market. This is a currency crisis disguised as a commodity spike. So what is your move? I am not here to give you financial advice. I am not a guru, and I certainly do not have a crystal ball. But I have a dossier of evidence that suggests the game is rigged against the passive observer. The system is counting on you to be asleep at the wheel. They are counting on you to react emotionally to the red candles they paint on the screen. They want you to capitulate so they can harvest your labor. This brings us to the final verdict. You have a choice to make right now. You can continue to operate on autopilot, trusting that the indices and the funds have your best interests at heart. You can accept the official story that this was just a technical adjustment, or you can wake up. The data we have uncovered suggests that we are living through one of the greatest wealth transfers in history. The illusion of paper wealth is being used to strip mine the reality of physical wealth. Do not expect understanding from the crowd staring at shadows on the wall. When you explain the difference between paper price and physical value, they will look at you like you are speaking a foreign language. They point to the TV and tell you everything is fine. Truth is a solitary journey until reality strikes. But look at the comments below. You are not alone. We are building a network of intelligence that bypasses the mainstream filter. If you've seen the cracks that others refuse to acknowledge, then stand with us. Sharing this dossier isn't about gaining views. It's about building a fortress of knowledge before the next harvest begins. Do not let this investigation die in the algorithm. Send it to those who still think their future is safe. Force the conversation. The only way we stop being the liquidity for their exit strategy is by becoming the players who refuse to fold. The machine only works as long as we don't know how it operates. Now we know. The harvest is over. It is time to plant our own seeds.